Welcome to the Money Insights Podcast, where high-income earners come to learn wealth-building strategies that will take them from high income to high net worth. With your hosts, financial and wealth-building experts, Christian Allen and Rod Zabriskie.
Welcome into today's episode of the Money Insights Podcast. I'm your host, Christian Allen, and with me, as always, Rodney the Pod Zabriskie. Rod, it's been a while. What's going on, man?
Hey, I am doing great. It has been a little while since we recorded. Great
Christmas.
holidays.
I was going to say New Year's, Christmas. Man, we've been through it. I've been on my trip to New York.
Yep.
It's been a while, right? So it was pre-New York that we last recorded. And so that's been like a couple weeks. It's good to see you, man.
Yeah, you too.
How's the family? Everybody good? Do you have any like big eventful things that happened during the holidays?
We actually did. So, and I'll give my wife credit because she came up with this, but we found out that, at least where our son lives in El Paso, that the stork doesn't bring babies, Santa Claus does. We actually had a grandchild born on Christmas Day.
I was like, wait, what? The stork doesn't? Santa Claus brings the baby. Well, that's crazy. So
Yeah, it
congrats
was wild.
to your son
Yep.
and daughter-in-law,
Spencer.
correct?
Yep.
Okay, that's exciting. And you're a grandparent again for the
Third time.
Third. Oh, yikes. I'm getting ahead of myself.
That's okay. You'll say I have 14 kids. Would I have 7?
So what's the difference? Either way, Rod, it's growing. The posterity is growing. So that's exciting. Congratulations, man. That's a really fun Christmas present.
Yeah.
I don't know how you could ask for something much better. Okay, Rod, let's put it this way. The wheels in my head have been turning.
Okay.
Right? And I've been watching a show, American Greed. Do you know what it is? You've seen it, right?
Yep, I've watched it.
Okay. And I've like run across it here and there, and it's one of those things where I'm not really like the type that likes documentaries. That's like not usually my thing.
Mhm.
And so, but what I noticed is that every time I ran across it and started like, it just would hook me, and I would just end up like becoming interested in the whole thing. And so I was like, what the heck? I think I'm going to watch a few of these. And I just kept watching them.
Yeah, it's one of those weird things where you're going to watch a train wreck every time, but they draw you in and you're like, oh man, this is just wild.
Yeah, it is wild. And it's just like wild story after wild story. And the reason I bring that up, Rod, is because that is the inspiration behind today's episode. Today's episode is how to spot a bad investment. Now, let's say this, there's co-inspirations, or maybe there's multiple inspirations, but the American Greed element that we're going to go through today, that one is certainly inspired by American Greed. But the overall premise, I think, is really important. And certainly people in our community are feeling the struggle. Now, let me be really clear as we get into this. This is not us suggesting or putting blame on people in situations where investments have gone wrong, right? That's just going to happen, right? Sometimes it's outside of anybody's control, right? When we have some like a 2008 crash. Now, I shouldn't say it's outside but very few people saw the writing on the wall in enough time to make the correct adjustments so that they didn't have investments that blew up, right?
Yeah.
So like this isn't an episode where but what we are going to do is we're going to talk about how to spot a bad investment, because it's one of those things that's super important. It's going to be the basis for the overall return we create in our portfolio. The better we are at learning how to, basically spot the bad ones, then we're going to have more success. It makes sense, right?
Yeah. And it's part about doing your due diligence. And while you're doing that, if you spot the red flags and you do something about it and you get past it, then great. But if you spot the red flags and you do something about it and you uncover, you're like, oh, okay, yeah, they're just not really giving me what I need, then you don't worry about that investment at all.
Yeah, exactly. Okay. So, but we're going to have a fun little spin and element to it. And that is that I've got a bunch of American Greed episodes in my head, and some of them on paper here, that I'm going to talk through so that we can kind of feel like we're learning lessons. So in my mind, the thing that I think stood out is I kept saying like, gosh, if they just look for this or you see this. And now let's be really clear. Not all of my investments have nailed it out of the park. The good news is a lot more of them have than haven't. right? And that's kind of the critical thing that we want to have happen. And so like there's an element of what we can control, and if we can at least like be really good at those things, then I feel like in the overall scheme of things, we're very likely to have a high probability of success in the way that we invest. So again, we're going to talk about we're going to focus on kind of the bad side, but we are going to also talk about the DNA and what makes up a good investment, because the opposite is certainly what makes up a bad investment. Okay, but before we do that, Rod, we're going to start out with a fun one. So, Zach Horowitz. I got to tell you about Zach Horowitz. Zach Horowitz raised something like $650 million in a Ponzi scheme. It was like an LA Ponzi scheme. He started to tell people that he had these contracts with big companies like HBO and Netflix and a bunch of other big companies. And somehow he got on like huge investors to the tune of, again, $650 million. And guess what? None of it was real. Like it was all fake. The contracts were fake. The paperwork was fake. He did all the fake accounting. It was just completely and totally fake, Rod. I was going through it. I was looking at it and I was like, how in the world does that happen?
Yeah.
You've got to be like pretty sophisticated to pull that off, right? And can I just be honest, as I was thinking about it, I'm like, sometimes even if you did do good due diligence, you can miss things, right? But in this case, there were some really obvious ones. For example, the contracts with HBO and Netflix, it was really easy for people to just check and make sure he actually had the contracts. And just nobody, I mean, eventually they did, right? But that was after the 650 million had been raised. And for a lot of people, he just spent their money on his lifestyle and other stuff. So there's a bunch of stories like that. But
did he have a history of having contracts like this? Like, was there any
No, it was kind of like
production
out
that
of
it
the
actually
blue.
happened?
Nope. There was nothing. There was no production. Like it never. I think he had his toe in acting, like in general, that kind of thing. But he just like used his acting skills to become a phony like mogul,
Wow.
right? And again, it's really sad because tons of people lost a lot of money. And so in my head, I was thinking, how does this happen? And then, I just started seeing like the red flags in this situation were pretty obvious. And so then I like started to think through myself, like, what can I be doing today to make sure, one, that I'm making smart investments and doing proper due diligence? And number two, how can I make sure I'm helping and steering our clients to do the exact same thing? Right. And listeners, so that people know that there's a correct way to go about this that will, again, not give you like 100% success, but that will give you a very high probability of success. And that's what we're going to talk about. Okay, here we go. The anatomy of a good investment, Rod. That's what we're going to start with. Why don't you kick us off with talking about some of the principles that make up a really good investment?
Yeah. So the first one we're going to talk about is transparency. And
that's one of my favorite words, Rod. Favorite words in business is transparency.
It seems so obvious that you should be able to clearly see verifiable information, audited statements, these kinds of things. And yet sometimes people get caught up in the details of the investment opportunity and I'm going to say forget, maybe don't push things far enough to get to the point where they're seeing those things. But yeah, that's absolutely critical.
Okay. So it's one of my favorite things in business. Like you can't just tout it. You actually have to live it. Right.
Sure.
But to me, when I can see that people are going above and beyond, whether it's a business opportunity, whether it's an investment, like when that's happening, I just feel so much better about what like the outcome is likely to be. And again, history tells us like again, we're going to end up talking about the positive and the negative side of it. But when I think about the negative side, there's like nothing that's more alarming than situations where the people I'm working with are hesitant to give me or to be transparent and just provide all the details. You know what I mean? It's like one of the absolute red flag warning signs that you either need to dig deeper, right? Because I'm not suggesting always that it's, not a good investment at that point, but sometimes they just need to take it deeper and make sure that they're providing that level of transparency. Whoever is creating that investment opportunity.
Yeah, the information that they're providing has to have some substance to it. If it always comes back to the the spin or the feel good or that kind of thing without getting into that substance.
Ooh, the sizzle. It's got to be more than the sizzle, Rod.
Yep. If it always comes back to that, then that's going to be a huge red flag
Yeah.
for sure.
Yep. Okay, good. So transparency is a super important element and principle of a good investment.
Okay. And then number 2, aligned incentives.
What does that
Which
even mean,
means
Rod?
what
What does
that
that
means
mean?
is that
Aligned
if
incentives.
they're suggesting I as an investor should get involved and certain things lead to my success, well, it has to be the same for the provider, the operator, right? So if, in other
Mm.
words, if the operator succeeds solely from me giving them money, whether they grow anything, whether they turn the business into anything, whether whatever the investment is, that's not going to work, right? There has
Okay,
to be
wait, wait,
some
wait, wait, wait,
value.
wait. Back up, Rod. You're telling me that it should be more than just like collecting the money? Like it should be more. Okay, well, here's my question to you then. Why, and I'm going to beat up the traditional world, is it so rarely like that? In other words, what you were describing is exactly the opposite of what we see in traditional financial planning, right? Typically, let's say I sell a mutual fund share. I'm typically going to
Mhm.
get paid. Even if I get paid on like a residual basis, I'm still getting paid regardless of whether the investment does well. I'm just getting paid
Right.
on the value of it, right? And if
Yeah.
it's an A share, for example, I'm just getting paid anyway. So this is
Yeah.
an interesting thing to think about, but in that situation, at least from the advisor, now that's on a lower level, right? We're not talking about at the upper echelon of management in a mutual fund here. So it's maybe a little bit different. But I would suggest that it's interesting that we're saying that a good investment has aligned incentives. And so often the advisors that are giving us advice don't have aligned incentives with us.
Yeah.
Just a thought.
And even in some situations where it looks like they do. So for example, if I receive whatever, a quarterly a quarterly compensation based on a percentage of the overall value of the portfolio, the assets under management,
Yeah,
then there is an incentive there
there
to
is.
grow it.
Yes, they want to
The
grow it for
question
sure.
is, am I in a position where I can?
Yeah, that's a good point.
Do I have
Right.
any
They
influence
don't have
on the
any
growth
like
or the whatever happening in the market? So it does have to go beyond just, "Oh, yeah, I benefit when you benefit."
it's
Great,
like, okay,
that's
well, how are
true.
you going to I guess they would say, well, I'm going to do that by, making sure we have good asset allocation or whatever, that kind
Yeah,
of thing.
yeah.
Okay. So here's a thought though, Rod, because we're not suddenly gonna get financial advisors running around that are able to directly align incentives. Like right. Because that's a nice like theory. It's a nice idea. Now,
Mhm.
in the alternative space, that's one of the benefits is you can get closer to that, right?
Sure.
I can have operators who have a significant amount of their own money into a deal and so they're willing to put their stuff on the line, and that
Mhm.
always feels like okay, they clearly believe in what they're doing here, you know what I mean?
Yeah,
so
yeah.
so I think that's important, but I wanted to just go back to transparency and just say like the good thing is or what I would look for is if I don't have aligned incentives, transparency is even more critical so
Sure.
that I can just know that. If I
Mhm.
know that and I'm making a conscious choice saying, okay, I realize that this is how it is. They're being very open and transparent with me that this is the way that this works.
Mhm.
Well, then I can make a decision and I can still potentially feel good about it. That's my
Yeah.
kind of philosophy around that. It doesn't mean that it just because there's not aligned incentives or at least not as aligned as we would like, it doesn't mean it's automatically bad, but it means it's really important that I know that so that I can make good decisions and feel good about it at the end of the day.
Absolutely.
Okay. Okay. So transparency is super critical, aligned incentives. And again, I go back to the alternative side of this for just a second before we move on to the next one. And that is a positive thing that like we oftentimes see, right?
Mhm.
Most of the time, operators are touting, and maybe this is a question for you, Rod, because it feels to me like most operators are touting putting their own money in it. Is that enough?
And this is an interesting one because let's go like the model of general partners, and then you're bringing in limited partners. They're the investors,
Yeah.
right? So to your point, if the general partners are not putting any money in, if it's all just sweat equity, I think that can make a difference.
Yeah.
Now, are they incentivized to grow it? Of course they are, right? That's where they profit
Right.
all. That's where they're spending that time and that expertise and all that comes to fruition. But yeah, if they're not putting anything in, then I think that's a fair question, to know and
Yeah.
understand. And then you can, to choose what to do with that. But then secondly, a lot of times the general partners will build it so that the limited partners benefit first, right? They get their payout, and then whatever's left over, the general partners get, which again sounds great. It might just be, well, put it this way, if something starts to go bad, they're no longer incentivized to turn it around and make it work for the limited partners, right? So even though as a limited partner, I love to hear if the general partner says, hey, you guys all benefit first before I get anything, it sounds great. And yet from the standpoint of that aligned incentives, it might be better if they get some benefit along the way with the limited partners first. And then of course, all the leftover over and above,
Yeah.
then they're going to get as well.
So what I'm hearing you say though is there's like maybe two elements to this. One is potentially putting their own equity into it, and then the other one is
Mhm.
just the overall structure of the investment
Yeah.
and how, we go through getting and how they're incentivized within that structure, right?
Yep.
Those are things
Yep.
we have to know. And again, we go back to transparency. Okay, so the next one we want to talk about, Rod, and this one's super important, especially when you get into this like negative scammer space.
Mhm.
Like you see this a lot, but you've got to be looking at realistic returns. Now, can I just honestly say when I started to move on from more to the alternative space, I was skeptical often because
Mhm.
oftentimes the return profiles were a lot higher than, what I would like. But when I was a more traditional investment advisor,
Yeah.
like I was pretty conservative. I didn't like the idea of over promising and under delivering. And
Mhm.
so, I might use like, which at least in that world was really conservative, maybe something like, showing investments growing at a 6 to 8% average return, something
Yeah.
like that.
Mhm.
That I thought for the that I think for the market is a pretty reasonable and probably conservative estimate. But that's what I was touting, right? And
Mhm.
so my mom was actually unfortunately the victim of a Ponzi scheme as herself. It was a Ponzi scheme that started out with very real estate.
Okay.
They owned some properties, right? And they put out these notes. They called it a REIT, right? And that, I mean, it was structured like a REIT. And
Mhm.
so, but the note would give you a 12% return. It was just a guarantee note for 12%. Well, after things went bad, they couldn't deliver on the 12% anymore. And sadly, in that situation, my mom, a widow, I've talked about this before on the show, but like
Mhm.
she lost all of the money she put in that. Now, luckily, it wasn't everything she had, but it was
Yeah.
still like, $80,000. And when you looked at that, that probably represented, you know, 20% of her funds available to live out the rest of her life.
Yeah.
So anyway, I think about those things and I'm just like, gosh. Anyway, so back to the realistic returns. What do you think that means for you? What does realistic returns look like for Rod, and like what kind of advice might you give to listeners about, how to keep that element in mind? Like what does that really mean?
Yeah. So number one is it depends on the industry, like what you're investing in. So kind of getting to your point, if people are used to thinking about it in terms of 6 to 8% returns, but then they move into a real estate type of situation where you can realistically expect 11 to 15% average. Again, average
Mhm.
when things are going great, it's obviously higher. You
Yeah.
don't always get that. You don't always have positive returns. But the point is that the average return profile is expected to be higher in that world than in the traditional world. So just because it is offering a higher return doesn't by itself mean it's unrealistic if it fits the profile of the kind of that category, right?
Yeah, I totally agree. So like in that world, if you're seeing 15%, I'm not saying like, oh, this is crazy. Right now,
Mhm.
now if it's a guaranteed 15%,
Right.
now that's one that you run away from. It's not that nobody could ever deliver that. In fact, most of the time what happens is somebody does deliver something like that and then they just assume they can continue to deliver it.
Mhm.
But
Mhm.
like if that's a guaranteed return, I would just totally avoid it. On the other hand, if that's the pro forma of what their expectation is, assuming, reasonable other, factors that are
Mhm.
put into the equation, like if those things are all individually reasonable, and now because of that, we're showing that, like that's something that I can get behind, right? But
Yeah.
if I'm saying I'm guaranteeing this, that's a red flag.
And that word is usually going to be a red flag. Maybe not red flag like always, but because then it goes back to the viability of the company or the provider that's
Yeah.
promising
The
that,
the
right?
issuer, the guarantor has to be somebody that can legitimately guarantee something. And again, it has to be realistic. So like you think about life insurance contracts, right? We talk about in a whole life contract that there's a guaranteed return, but it's been 3 or 4%, right?
Mm-hmm.
So like in that situation, or a government issued security, right? Like the
Mm-hmm.
government has never defaulted on
Treasury
the
notes, bonds.
banks. Yeah, treasuries. That's what I was trying to come up with. So there's situations where guarantees can be real and make us feel comfortable. But like if you're getting into guarantees that are anywhere in like the double digits, like it
Mm-hmm.
just feels like it's crazy, right?
Yeah.
Really, regardless of what industry you're in.
And be careful as an investor that you don't substitute the word guaranteed for something else that they're saying. So if they say a preferred return or promised return
Hmm.
is not the same as a guaranteed, right? You don't remove the risk just because they're saying, hey, this. So like in your mom's case, they're saying, hey, this is what we pay out. Don't let yourself substitute that word in and call it a guaranteed return.
Yep. Super important. Now, just to be really clear, Rod, hers was it said guarantee right onto the front of
Yeah,
it.
see, that's
Which again, I did, and
tough
this
one.
was sad because the financial advisors she was working with are the ones who steered her there. So she
Yeah.
was working with a more traditional financial advisor.
Mhm.
Oh man, they just did a terrible job, Rod. It couldn't have been worse. So I had to really do some work to undo like some of the harm that was caused by it. But
Yeah.
they should have known better, even in a time when real estate was crushing it. Like that to me is just like a principle that we should have learned from Bernie Madoff, right? Like, or probably further back than that. Like, you just
Yeah.
have to. There's certain things. Now I know these are different, but I'm just saying like there's these obvious principles that we've seen just complete disasters historically that we should at least know enough to be like guarantees are a red flag in
Mhm.
general. Again,
Yep.
high guarantees, unrealistic guarantees. Okay, so we talked about transparency, aligned incentives, realistic returns, and credibility. When we're talking about the principle of a good investment being credibility, what does that mean? What does that look like?
I mean, track record is gonna be probably the best way to show this, and that can come in obviously a lot of different forms. If it's the type of investment where they've done it year in and year out for 3 decades or something, then obviously that creates a really good track record, right,
Yeah.
of success. Now, sometimes you're going in and you're saying, okay, this individual is with a different team, but they come from a background where they've been able to do certain things, and that obviously brings credibility to the team. And that's why you're
Yeah.
strongly considering it is because of that. So, and like you said earlier, these things don't always steer you away from bad returns or investments that go bad. Um, but again, if you don't have that proven track record, strong leadership type of thing, then you need to dig deeper. You have to get past that to create some level of comfort, because if that's what you know and you don't see additional things that allow you to get past that, then you should walk away.
Okay. So, and we talk about this all the time in our inside due diligence, finding people who have had past success. And so
Mhm.
I think what happens when I hear that, I'm like, well, that's great, but like, what about new organizations? And I think you did a good job hitting on that. Like the ideal, if you're going to go into something that's like a newer investment, like it's not that new companies can never be built, new investment
Mhm.
opportunities can
Mhm.
never be created. But to your point, the ideal situation is to be working with people who may have had success with other situations before they came to start their own. What you probably want to avoid generally is a situation where it's somebody who doesn't have any track record doing something brand new, right? Like
Yeah.
you're and if you really believe in it, then like, hey, maybe I could use my high risk money toward that, but that
Mhm.
certainly shouldn't be at the core, right?
Yeah. And
You've got to be a lot more solid inside of your core investments.
and then they have to line up on these other principles that we've talked about, right? Because if they don't, they're not transparent, they're not bringing real credible, at least facts and details to show you why they feel like they can do what they're doing, then I wouldn't be going with that. So.
Okay, and the last one that I have here, and there may be some other ones, right? I'm not suggesting there are no other principles
Sure.
that make up a good, but these are kind of the core ones that came to me. Sustainability, and what I mean by sustainability, I'm just talking about, and it kind of goes in line with credibility, but a long-term strategy for consistent growth moving forward, right? So then
Mhm.
we have the element of credibility that comes from past successes, and now we want to see beyond that because that's not good enough, right?
Mhm.
We can't
Right.
just say like, oh, these people have had success in the past. I don't know what they're doing, but I want to be part of it. Right. Well, you
Yeah.
could, and maybe that wouldn't be even the worst thing, but like the better approach would be to say, hey, these people are having a lot of success. I'd like to understand what it is they're doing to know if I can get in on if I can get behind what they're doing and understand it. Cause I mean,
Mhm.
I did a little video that hit pretty well. This was probably maybe a couple months ago, and it was Robert Kiyosaki, and he was giving the advice of only invest in things that you understand, right? And
Yeah.
so in his example, he's like, I understand horses and I understand land. I don't understand this stuff over here. Like, it's just kind of one of those classic Robert Kiyosaki moments.
Yeah.
But again, when I'm thinking about sustainability, it is important that I at least have a baseline understanding of what the investment is and understand how it's going to produce the result, right?
Mhm.
Because
Mhm.
that is one of the most dangerous things. If I'm looking at an investment and I don't know, like I can't put two and two together. Let's say that they're like, okay, this is what's going to happen, but they can't adequately explain how that is actually going to create it. Well, to
Mhm.
me, that's a problem, right?
Yep.
So,
For
okay.
sure. Yeah.
Okay. So transparency, aligned incentives, realistic returns, credibility, and sustainability make up the good things that we want to be looking at. Therefore, Rod, I think it's easy to kind of figure out what the negative things. So let's
Mhm.
talk a little bit about those. The anatomy of a bad investment. Lack of transparency is the starting point. So now I've got some stories for you, right? Actually, let me hit the five. So lack of transparency, misaligned incentives, over promising. Ooh, I like this one. Polished deception. Okay, that's a
Mm.
bad one, but it's out there. And can I just say,
Yeah.
one of the crazy things about these American Greed stories I'm going to share with you guys, they are all new. Like these aren't like happening 30 or 40, 50 years ago.
Mhm.
These are like happening right now, right in the midst of us. In fact, it might even be easier today because of all of the technology that we have available to us, right?
Yeah.
People who didn't have the ability. I mean, again, you think about AI, and I love AI, right? But like
Mhm.
AI gives people the ability to do things that they wouldn't be able to do otherwise. So like that gives like good people an opportunity to do really cool, unique, to be innovative, and like, sinister people, it gives them an opportunity to do some of the things we're going to talk about. Just said, oh, and the last one is exploitation of trust. And I just like, again, this is one of the biggest things I think about. Most of the time when people get into an investment scam, it's because they have trusted the person or somebody close enough to
Mhm.
the situation that they feel like it's likely to do well, right? It's
Yeah.
almost like, and this is the habit, I think this is something we all get stuck in is we're like, oh, well, if they like it, it's probably good.
Yeah.
I've certainly done that, right? And what I'm
Mm.
suggesting here is that shouldn't be enough for us. We should take it a step
Right.
further. We should take it a step
Right.
further.
Yeah.
Okay.
So trust is a big piece, but we will often talk about trust, but verify. You
Good
don't
call. Trust
ignore
but
the other
verify.
principles just because you trust this person. That's a good starting point, and then you move on to the other principles and do your due diligence for sure.
Okay, so let's talk. Yes, I totally agree with you, Rod. Let's talk about a couple of fun examples. Fun, I say fun, like tongue in cheek, because there were absolutely people who lost huge amounts of money, who were
Yeah.
hurt. These are not funny, but they're interesting and kind of an intriguing way to understand some of the negative side. Okay, so the first one I wanted to hit on was a company called Theranos and Elizabeth Holmes. So I actually watched a miniseries about this. A lot of people might have already heard of her, but Theranos raised $700 million. She had like government officials, she had famous people all
Mhm.
backing her company and just putting out, and she had like big companies like Walmart and Amazon. Like she had really like captured the nation because she was promising to revolutionize something in the healthcare world where you could go into like Walgreens, for example, and
Mhm.
you could take a little blood test and it would give you all of your blood test results right there with the prick of a finger, like tiny,
Mhm.
tiny, tiny. Well, despite the fact scientists were saying like, there's no way to do this, there's not enough, you can't get enough blood to be able to get all of those results and make them accurate. She just kept claiming that that's what was happening. And then she even attempted to deliver it and created this machine. But Rod, this was wild. They would have people do it, but they wouldn't get the results immediately. They would then like ship it back to somewhere else, actually do a test on it the best they could, and then to send it back out. But they were wildly inaccurate. And so
Wow.
eventually people were like people came back and were like, I've done this test 3 times. Imagine this, Rod. Imagine that you go into take this little blood test and you walk out learning you have some, some disease, because this is what happened. People left with like, oh my gosh, I have a real health problem, when in
Yeah.
reality they actually did not. And
Wow.
the opposite too. The opposite was the same thing.
Mhm.
They left
Mhm.
feeling like, hey, everything's great, when in reality there was clear warning signs, but her machine or technology didn't pick it up. She's in prison now, thank goodness. But like, I just think about how big that scandal was and how
Mhm.
far they took it. Well, here's the deal. It was wildly private. She just would not let the details out. And it was kind
Mhm.
of suggested that the reason for it was because like her technology was like that special. She just couldn't let people get
Yeah.
their eyes on it. When in reality,
Competitive advantage.
yeah, and
So
she
yeah.
was hiding behind that, to the point where like scientists were starting to leave the company because they couldn't, like, they started to see what was going on and were like, I
Mm.
can't be a part of this. I can't go to work in this kind of a situation where
Yeah.
they interviewed someone who's talked about how it was so private that they had to have, it was almost like military level kind of
Security.
security, yeah,
Clearance. Yeah.
making clearance in order to get through it. And
Mhm.
they were just like, well, if it's so great, like, why are we hiding it? This is supposed to like change and help the world, right? Well, anyway, turned out it was completely fake. That's not the
It's
only one,
wild.
but that's a good one because we can definitely learn about a lack of transparency. Negative example number 2 is Nikola. Have you heard of Nikola, Rod?
I hadn't before this.
Okay, okay. And I had not either, which is wild. So Trevor Milton promised hydrogen-powered trucks. He
Sounds
basically
amazing.
said, I've got trucks that are just like Tesla. And this is what happened, man. I just love this. So he goes and like records the truck as if it's driving. He finds this little road in rural Utah that has a hill at the front of it. And again, we've got this big semi truck. And
Mhm.
then he just like lets that thing coast until it gets to like 55, 60. And then they take a shot of this like hydrogen powered truck really running. He ran like the entire thing that way and duped a lot of people, like a lot of people, to the extent that its valuation hit, guess what? 34 billion.
Wow, that is wild.
$34 billion on an investment that was totally phony. Isn't that
Mm.
wild?
That is just crazy.
Okay, so watch out for your Nicolas. And then the last one I want to hit on, and this one just like hits on all of the worst notes. They called it BINT, and it stands for Blessings in No Time.
Mm.
Picture this board, Rod. We've got this like playing board. You start at the outer part of it, and I have to work my way into it. Well, what they told you is that you pay $1,400, and that when you get blessed out, when you get into the middle of the game board, I get $11,200. Pay 1,400 in, get 11,200. That's supposedly the guarantee. Sounds pretty good, right? Although I look at that and I'm like, oh gosh, I can't imagine why people would fall for that, but
Yeah.
they did, right? So, and a lot of people. I think managed to raise like $40 million, 40, $50 million, and it was all from people who, oh, by the way, you could only be African American to do this. So it
Okay.
was specifically for Black people, and it was very much focused on religion. So what they did is they preyed on the combination of religion and like status and race, all of these things, to just dupe people out of millions of dollars. Man, it just got my blood boiling, cuz like when I think about people being manipulated in like for religious reasons, like
Yeah.
with their beliefs, like that's just like as dangerous as it possibly comes. So make sure you avoid any investment that is preying on things like that.
Yeah.
It should be an automatic red
Can
flag. I'm out of there.
can I ask a question? How do you move inside the board? Is it like recruiting people to participate? What was the
It felt like pretty much all luck. So what would happen, I think there was a recruiting element that would give you
okay.
some like there was some specific activities that could give you a bump, but what happened is you didn't actually ever do it. So
Mm,
when people would come out and talk about it, they'd say, "Well, I moved up and then I moved back and then I move up and then I move back." And what they did is every like once in a blue moon they would bless somebody out so that people thought
mhm.
it was possible and that it was happening, but in reality like very few of them were, and they just ultimately ended up embezzling millions of dollars. And
Wow.
of course, they went to jail for it. So, anyway, those are just some like, again, kind of wild stories about falling for brutally bad investments. That's probably not the people who are listening to this pod. Um, but I just thought it was interesting and gave us a little extra narrative since I've been binge watching American Greed.
Mm,
Okay, Rod, I want to talk before we close the pod. I want to talk about the probably the most important element, and that is the key warning signs for us to be looking for when it comes to spotting a bad investment. And we're just going to roll through them. The first one is anything that you feel is like a pushy sales tactic. If you feel uncomfortable, if you're being pressed to do something, man, that is a massive red flag. Even
yeah.
if it's a good investment, you should never feel pushed into doing something. Whenever that happens for me, that my antenna goes off and I just am like, I'm walking away.
Mm.
So that's my first one. Do you have any takes on that, Rod?
I mean, maybe some examples that I've seen it is the deal is closing at noon tomorrow. Only people who commit right now have a chance of getting in.
Yeah,
Or
and why is that a
it's
problem?
well, usually it's not true. Like
Okay, that's a good
um,
point.
it's a false deadline that's put on it, so it pushes people to make decisions more quickly. And when we've talked about the sizzle, right? So they've given you all the sizzle, all the reasons why you should be excited about it, but it doesn't give you time to do the due diligence that you should be
Yep.
doing before you make the commitment to invest. So you should be talking to other people who do invest. You should be looking at the books. You should be looking at a pro forma. You should have time to do those things. And if they're not giving you that time, well, number one, that should be the response, right? Hey, I need time to do this. If I don't have time before your deadline, it's just not going to work for me. Um, but they should understand that too, right? They should be kind of built in to the things we talked about earlier, right? The
Yep.
transparency, the respect that they should be giving investors on the front end.
Okay, so the first one, pushy sales tactics, just run. Number two is lack of independent verification. So you should always ask for audited financials and third party validation. If you can't get it, then that is absolutely a sign that I need to think twice. Pretty
Yeah,
simple, right?
yeah,
Like the reality is that if I can't find other people who are standing up and, telling them that that either this person or this investment have a track record of success, right? As long if I can't do that, man, it's just scary. And we live in this space now. One of the things I found the most interesting about these American Greed stories was that they're happening today. Like these
mhm,
aren't
mm,
old. This wasn't like 30, 40 years ago. So here's what came to my mind. First, it's I thought to myself, isn't it easier with all the technology to like, do the due diligence to make sure that we're getting in the right places? But then I thought of the other side. Isn't it easier with all the technology to run a phony scam and make it look
yeah,
real? So like these are really hard things. So like these are just one of these steps isn't enough. Lack of independent verification is just one thing that I ought to be thinking about. And again, I had to think twice if it's not there. Okay, the next one we've talked about the sizzle. We've talked a lot about sizzle, Rod. If you
mhm,
feel like it's all sizzle, there's too much hype, big promises without substance, and that should always make you think twice.
yeah,
Have
for
you ever
sure.
experienced that like what kinds of situations come up that you can think of that fit that bill, Rod?
Well, here's the thing. I think somebody who is savvy in raising money, they're going to put some hype into it, right? There's going to be some sizzle because there should be reasons why you want to invest, right? The
Right.
good
So
of
there,
the investment is what draws people in. But what we're saying here is if that's the only focus is ever on, hey, come and get a 56% return and you don't have to do anything, and it sounds great, but there's nothing ever backing it up or not enough information to back it up, or these other things, you can't go out and do any independent verification, then that's not enough, right?
yep, I totally agree. Okay, so the next one that we want to hit on, Rod, no clear expectation of return of like how I'm actually getting the return. So this
Mhm.
is one again, I go back into like the hydrogen one, or I go into like some of these like really big ideas. What happens
Yeah.
is people can create this hype, right? That like, hey, we're going to change the world and you're going to get in on the bottom floor of this opportunity that goes crazy. Well, and then what happens is people skip steps. Even the best investors skip steps. Like
Mhm.
you don't get to be a $45 billion valuation if big time investors don't get behind it, right?
Yeah.
So, but when I look at that, I think to myself like, how did they ever like? How did they expect to get the return? Maybe they just expected if it actually works, it'll just kind of figure itself out.
Mhm.
But the reality is in a lot of these American greed stories, this was one of them that was really clear that there wasn't a clear
Yeah.
way of understanding how I'm actually going to get my money back. Think about Mr. Wonderful. What would he say? He'd be like, okay, how am I going to get my money back?
Yep.
Right? That's the
Yep.
question he always asks. Well,
Yep.
turns out Mr. Wonderful, while he might be a jackass, he's a pretty smart investor.
Yeah. It is something that we often forget, right? We do look at the returns, and even in the best of investments that don't have anything phony going on with it, you just need to make sure that you understand that. What's the timeline? What does the exit look like? And you also can't take that as gospel either. You have to take it with a grain of salt, right? If they're telling you 5 years, plan on a lot longer in terms of your projections and all that kind of stuff. Be okay with it going a lot longer, but at least have an understanding, have a clear conversation about what that looks like.
Yep. The last one we're going to touch on, Rod, is guarantees. Guarantees just don't exist in that many places. And
Yeah.
so, like, there are, again, we've talked about this a little bit. There are some places where I can get a guaranteed return. But if we're talking about guaranteed double digit returns, like, people just can't do that. There's no way to guarantee double
Mhm.
digit returns for a consistent period of time. That doesn't mean that someone couldn't get lucky and that could happen, but the reality is I can't guarantee it. And so if somebody is guaranteeing that, to me, that's a clear reason to think twice about the investment and probably just walk away.
Yeah, and I think it points to an unrealistic expectation. We just have to be on the lookout for those things where if they're putting it out there that way and it's really, again, a guarantee is a great example. It's unrealistic, then that's enough for me to not want to work with the person, right? If they're putting that stuff out there, again, regardless of how I feel about the other things that I'm seeing, I have to just be willing to walk away on stuff like that.
Yep. Good thoughts. Okay, let's close with just some actionable steps for everybody. Number one, just make sure we research thoroughly. Like this is
Mhm.
obvious and we talk about it all the time, but you just have to do it. You've got to ask tough questions. You've got to make sure that you consult with other experts, right? Especially if you're getting into a situation that I don't have as much like maybe familiarity with or comfort with. That's a great time to use the resources in your world to find people who do know about it and can either give you like the validation you need or give you the wisdom to move away from it. Right. So just making sure that we are asking tough questions, we're consulting third party. And then the last one is to trust your instincts. I have a little bit of like apprehension saying that because sometimes our instincts are wrong. But if
Mhm.
we like, I guess what I'm really saying in this, Rod, is that if it feels off, if it feels too good to be true, even if we get really excited about it, man, the chances are we're going to lose on that one. So,
Yeah.
again, if it doesn't feel right, like it just doesn't make sense in my opinion. Always walk away from the I would certainly much rather miss out on a great investment than end up in one that blows up completely, right? And this is especially true inside the alternative space that we so frequently play in. because things are not nearly as regulated as they are in other places. Like we talk about the volatility of the market, but the reality is when I put my money in a mutual fund, I'm probably not going to lose all of it, right? I might go up or down, but in the alternative space, if I screw it up, I could literally write a check and 6 months, a year, 2 years later, find that it's all gone. So it just means that while the opportunity is really is incredibly valuable and it gives us the opportunity, like we can do more with it, there's also like greater responsibility to make sure we do it right, because I would say the downside's probably, a little bit greater than if I was just investing in mutual funds or whatever.
Yeah. Which goes back to a lot of the other principles we talk about of diversification and liquidity and other things like that, because there will be deals that don't go the way we wanted them to go, right? Like we're giving these examples where they were clearly fraud and just fake. There are real investments that also go bad as well, right? And so we just can't get so caught up in the hype. And again, a lot of these things that we're talking about to the point where we're not smart about being calculated, being diversified, all these other kind of just core financial principles that we need to stick to.
Okay, so research thoroughly, ask tough questions, consult trusted experts, trust your instincts. Thanks everybody for listening, and we'll see you next week.
Thank you for listening to the Money Insights podcast. To learn more about the financial and business strategies discussed in this show, please visit moneyinsights.net. The views and opinions expressed on the Money Insights podcast are not intended to be individual financial, tax, or legal advice. Always consult with the appropriate advisor before making financial decisions. And if you're enjoying the show, please feel free to rate, subscribe, and leave a review wherever you listen to your podcasts. This will help others find the show and learn wealth-building strategies for themselves. Thanks again for tuning in, and we'll catch you in the next episode.